Okay, hi everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have Bill Crossland, the CEO of Thermal Energy International. Before we get started, I want to remind all participants that your microphones have been muted. And at the bottom of your screen, there's a chat feature, and we encourage the audience to ask questions by using this feature. Thermal Energy trades on the TSX Venture Exchange under the symbol TMG and on the OTC under the symbol TMGEF. The company is trading at 8 cents with roughly 160 million shares outstanding and a 12 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks, Trevor. Thanks, everyone, for being with us today. As Trevor said, we've got Bill Crossland from Thermal Energy. We're really happy to have him on board. As you guys know, we've actually put out a report on the company. We are all shareholders and like what we've seen so far. We're fortunate to have Bill with us today. He just reported his latest quarter numbers, and we want to take this opportunity to have him speak to us and answer some questions and give us an update. So with that, Bill, I'm going to turn it over to you. We're going to do something slightly different where we're going to allow him to give a presentation, and then we'll follow up with questions. So Bill, thanks for joining us today.
Thanks, Paul. Thanks, Paul and Trevor. So, it still says here, if you want me to share the screen, the host has disabled participant screen sharing. I can just sort of speak, or if you want me to share the slides, I'm certainly able to, but it looks like someone needs to give me permission.
All right, so we'll, Trev, if you want to give him a go. There you go. That should be working.
Yeah. Try now, Bill.
There we go. Let's see here. And so people can see that, and I will, in the beginning.
Yeah.
Yeah, okay. So,
perfect.
Thanks, Paul and Trevor, and welcome everyone. It's Thursday afternoon. So I know some of you know a little bit about thermal energy and others may not know anything. So I'll try and zoom through the background before we get to our current results. But just by way of background, Thermal Energy is a proprietary solution provider and a fully accredited engineering firm. It's really that unique mix of proprietary products and process and environmental engineering expertise that allow us to engineer, design, and deliver innovative and compelling turnkey energy efficiency projects that improve our customers' profitability and sustainability. At the end of the day, that's why we're in business. It's to improve their profitability. Everything, somebody's grinding something, it sounds like. Can anybody else hear that?
Nope.
I can. I think it's Paul's feedback. I'm just going to put.
Oh yeah, I'll go on mute. Yeah.
Yeah, everything we do for our customers to this day, it's nice that we're reducing carbon emissions, but they do it and they decide to do it based on return on investment. That is, the return that we're going to get and the money they're going to save from installing our product. A little bit of background here just to show you, because a lot of people ask. Thermal Energy has been around a long time. It was founded back in 1991 and it went public in 1994. I didn't get involved until about 2007 when I joined the board. What I saw at the time was a wonderful technology with great potential. And so I joined the board. I invested some money in the company at that time. I helped them acquire the GEM business in 2008. And then you sort of know what happened. We lucked out in that acquisition in 2008. We accessed the markets on July 4th, I think, of 2008. Yep.
Hate to cut you off, but I'm getting quite a bit of that feedback.
Yeah, so am I.
I'm not sure if it's from it could be your headphones possibly.
Well, let's see.
You know what? As soon as Paul muted himself there, it disappeared. So might be Paul's.
Okay. The headphones I use all the time, so I'd be surprised, but
it was actually Paul. So sorry about that. Sorry to interrupt.
No, not a problem at all.
Maybe we'll just take it right from the top there. I apologize about that. And I'll have Paul kind of patch in as we can here in a sec.
Okay. Let's see here. Yeah, so the quick start at the start was Thermal Energy is proprietary solution provider and a fully accredited engineering firm. And it's that unique mix of proprietary products together with engineering expertise that allow us to deliver custom turnkey solutions for our customers that improve their profitability and sustainability. And as I said then, you know, our whole reason for being is delivering a strong return on investment for our customers. So they get a great payback on our projects, and that's why they buy from us. We really are, you know, it's nice that they're cutting carbon emissions, being more sustainable, helping the world, but at the end of the day, they end up buying all these renewable energy solutions or alternative energy solutions because they save money, and that's why we're in that business. So way of background, Thermal Energy has been around for a long time, so some people are curious about that. It went public in 1994. It was based, it was founded by the inventor of our primary technology. It was called Flu-Ace heat recovery technology. I found out about the company in 2007, and that was sort of, for those that are old enough to remember, 2007 was the last, you know, clean tech peak. Clean tech was very popular back then. I found out about the company. I loved them. They had a great product with great potential, so I invested in the company and joined the board at that time. I helped them acquire GEM in 2008, which is our steam trap business in the UK. We did a financing in 2008 to complete that acquisition. We completed that financing sort of early July 2008. You know, 2 weeks after we closed, the markets totally fell apart, and we entered about a 3 to 4 year period of recession. There was a management shakeup in 2009, and at that time, you know, I knew the company well, so the board said, "Would you like to take a shot at this?" Because the company at that time, you know, was in bad shape. We had about $4 million in revenue. They were losing $3 million a year, and they had been losing $3 million a year every year for the previous 3 or 4 years. They had when I took over, they had about $3 million cash left on the balance sheet. So, you know, we knew pretty quickly what we had to do. It was, you know, slash and burn. So we reduced that loss from 3 million to 2 million. So at the end of the first year, we had $1 million cash left on the balance sheet. And from that point on forward, we've been growing the business with our own internal resources, our own internal cash flow without any external cash flow. So if you think about it, the 2008 right up to sort of 2012 was a recessionary period, difficult to grow. And so that period was, for us, was driven by cost cutting and corporate reorganization. Then in 2015 is for us is when things really started to change, and that coincidentally was with the Paris Accord on climate change. And so from 2016 through to now, we've been investing heavily in the business and growing the business. We acquired another technology in 2018. And how do I... There, that's how I do it. And then you got to the point that through our own cash flow, we've grown from $4 million in revenue in 2009 to our LTM for Q3 was almost $25 million in revenue. Our EBITDA almost LTM almost 3 million, and our net profit almost 2 million for the LTM period ending February 29th, 2020. So that's it in a nutshell. So very quickly, we're in an enormous, fast-growing global market. We have proprietary products sold to leading companies in a whole host of sectors. Very low capital intensity business model. We don't manufacture our own product. We outsource the manufacture of our product to our specifications. The GEM business has about a 75% gross margin, so very little working capital in that business. And the heat recovery turnkey solution, which is about 2/3 of our business, all those projects are done on a cash flow positive basis. So we get deposits up front, we get milestone payments, so they're all cash flow. So very little investment in working capital. We've been investing heavily for the last several years in the company, and we're poised to continue a strong track record of growth. I'll go quickly over this, but it really helps to highlight the opportunity represented by energy efficiency, because most people don't realize it. This is, you know, this Sankey diagram is done by the Lawrence Livermore Laboratory in the US. They do it every year for the US economy. And basically what it shows in a nutshell, it shows all the sources of energy coming into the economy, and whether it's electricity generation or residential or commercial or industrial, and then what proportion of that is actually used and what is rejected. Rejected is wasted energy. So you can see here that of all the energy coming into the economy, 2/3 of it is lost as rejected energy somewhere along the system. Electricity generation is incredibly inefficient. But where we're focusing is really this industrial sector right here. That's our target. And you can see that on average, most the industrial sector, they're about only 50% efficient. So that's where we're targeting. And that's why the International Energy Agency calls energy efficiency the world's first fuel and a hidden fuel, because most people don't realize it. So that's the opportunity we're going after. For us, the North American and EU market, which is our key markets, that's where we're focused. That's where we have offices. That's where we have people on the ground. That's about a $50 billion opportunity for us. And that's a huge number. I mean, obviously, I'm not trying to say we can grow to that level. I'm just pointing out, because people often ask, you know, are you running out of runway? Are you still able to find new opportunities? There's lots and lots of opportunity out there for us. Globally, it's probably about $250 billion. And the second thing I'd like to highlight, just, you know, in big picture, 30,000 foot level, is again, that's something that people don't realize. If you talk about the Paris commitment, where we've, you know, every country in the world at the time agreed to reduce carbon emissions to keep climate change within 2 degrees, where is that carbon emission going to come from? And the International Energy Agency says about half of it has to come from energy efficiency. That's compared to only 17% for renewables. So energy efficiency can deliver 3 times the reduction in carbon that renewable energy. And in order to do that, they say we need to increase our annual spending on energy efficiency by 9 times. So again, just sort of more big picture on the opportunity. And then the final one that I'll highlight that again, I like, this is a study done by McKinsey, and it shows the cost per ton of CO2 abatement. So obviously, if you're below the middle line, you're actually not only does it not cost you money, but it saves you money. If you're above, it's costing you money per ton of abatement. See, as all the orange ones, they are the lowest cost. Not only they not cost any money, they actually save money and improve our customers' competitiveness. To date, this number is out of date. We have to redo it. We haven't done it yet, and we just haven't had time. But as it is right now, we're probably saving our customers about $100 million in energy savings every year, because some of our equipment has been out there for quite a while, given how long the company's been in business. You know, that's sort of the equivalencies. These slides are all on the web, on our website, so I won't share them with you. But we're having a huge impact already. These are our products. So they're all complementary products. And part of our strategy is we've got a sales team on the ground in North America and Europe with a whole host of Fortune 500 customers. And so part of our strategy over the next several years will be add to the portfolio of complementary products. The first one was the FLU-ACE. That's direct contact heat recovery. These projects tend to be turnkey. They're sort of $500,000 to $2 million. Payback is usually 2 to 5 years. You know, 2 years maybe in Europe, 5 years in North America, where the natural gas prices are so much lower. Then the next product that we acquired in 2008 was the steam traps. These are a small unit about this big. You know, every company that uses steam has something called a steam trap that they use. And a small commercial laundry might have 10 steam traps, but a large chemical facility could have 10,000 steam traps. And all the traditional traps are based on a valve that opens and closes. So a steam trap is designed to reduce the water in the line. So if you think about a steam system, you boil the water into steam. As the steam circulates throughout the facility, it starts to cool down. As it cools down, it condenses back into water. You have to drain off that condensate, that water, or it plugs up the whole system. And so that's why they have these steam traps every so often to drain off the condensate. Every other steam trap out there is based on a valve that opens and closes. Bunch of problems with that. They fail. Major problem is they fail at about 20 to 30% per year. So you think about a big chemical plant that has 10,000 steam traps, they're replacing 2,000 to 3,000 of their traps every single year. So our trap has no moving parts, comes with a 10-year no-fail guarantee, and on top of that, it's 10 to 20% more efficient than the traditional traps. And then the other technologies that we acquired a couple of years ago, a little under 2 years ago, was what they call an indirect contact heat recovery unit. So in both cases, what the FLU-ACE and the heat sponge and the sidekick, what they're doing is they're taking a hot air stream It could be often it's a boiler exhaust, but it could be, an oven exhaust. It could be a dryer exhaust. Anywhere where there's hot air coming out of being exhausted to the atmosphere, we take that hot air, and we turn it into hot water. So we use that hot air to heat hot water. We give the energy back to the customer in the form of hot water. And as I said here, our engineered, all these products are customized to a certain extent. None of them are off the shelf. So they're all customized to a certain extent, but the turnkey solutions where we design it and install it and deliver them a turnkey package is about 70% of our revenue. The rest of our revenue is just where we sell them a piece of equipment. Okay, a couple other products that we're working on developing is, a low temperature biomass drying system. It's been in development for a while, but the great advantage here is it sort of moves us into renewable. When we go to a site, we need to find a source of heat and we need to find a use for that heat. And any site you go to, when you saw that Sankey diagram, you see that there's lots of waste heat. The challenge or the limiting factor is what you can use that waste heat. So this is a drying system that we have that can be used to dry biomass or food product, and it uses waste heat to do it. So it's another use of the heat. And then alternatively, we've got such great relationships with a number of our customers. They've got us to do other things. So one of our customers who we've done probably 10 or 15 heat recovery projects for them. We know how to work with water. So they asked us to do a water recovery project for them. We did that last year. We're also looking on FLU-ACE to actually recover water, because the FLU-ACE, it condenses the water out of the airstream. So if you burn natural gas, you get CO2 and water. So there's always water in the exhaust stream. We actually recover a lot of that water. That's a side benefit. We're working with one customer to see if that can be the primary use of the heat of the FLU-ACE. And then we did another project where we tied in the FLU-ACE to sort of supercharge a solar system. So we've got a couple of them. So those are just some areas for growth in the future. Our customers tend to be large multinationals. That's by choice. We tend to focus on customers, that use a lot of energy at one site, because if their fuel bill isn't sort of $1 million or more at that site, we just figure it's not worth our time to go and develop a customized solution for them. And we also like large multinationals, because after we sell them one site, we can then sell other sites once we develop that corporate relationships. But the key sectors, our largest sector by far is food and beverage, followed by healthcare and pharmaceutical. Pulp and paper is a big sector for us, but it tends to be fairly lumpy. It's big projects that come along every so often. Chemical, agribusiness, brewing, again, is sort of food and beverage. But when you think about it, it's any company that's using steam, and probably 80% of industry still uses steam and always will. And the reason steam is used is because it's a very efficient way to distribute energy and heat throughout a large facility. If you want to pump hot, steam is 1,000 times less dense than water. So if you have to push heat, out to a far, reaches of the plant, it's much easier to use steam than it is hot water. And so using all these technologies, we can recover about 80% of the energy lost in a typical boiler plant. This just gives you an idea of two things. I like this slide because it lists all the orders that we've announced over the last 12 months at the industry and the location, just to show you that we're diversified not only by geography, but by sectors. So tire manufacturing, specialty nutrition, brewing, snack food production, tissue production, animal nutrition, milk processing, food ingredient, beverage bottling. So it just shows you that we're, and if you go up again, the first three were EU, then North America, then EU, and a couple more in North America. So it's well diversified by geography. And strategically, we are focused on Europe. Strategically, we think it represents a greater opportunity, because to this day, energy prices in Europe are still 3 to 4 times what they are in North America. And a lot of the governments are more focused on carbon emission reductions in Europe. As I mentioned, we focus on large companies because we can do multiple sites. So, this food and beverage company that we've been dealing with probably for 5 or 6 years now, we've done 14 sites, 36 different orders. Major hospital group, 2 sites. Leading performance material, 3 sites. Another hospital group, 18 sites. So that's a key part of our strategy, is to focus on large multinationals where we can sell more and more to them and develop that relationship. And then for the last several years, we really have been investing in growth. So you can see these are all the people that we've added over since 2016. 24 new staff total over the last 3 years. So we've gone from, about 35 people to 60 people. And many of these positions are not contributing fully yet to results. It takes, because it's a customized sale, because it's a specialized technical sale, it takes a salesperson usually about 2 years. It's not until their third year where they're really generating some good results for us. And it takes an engineer about a year. And our entire company is roughly 45% salespeople, 45% engineers, and 10% admin. And anecdotally, most of the salespeople are engineers as well, because it's a technical sale. Again, this slide just sort of highlights where we have sold, but the little pins are where we have people. The orange pins are where we have offices. So our two major corporate offices are in Ottawa, Canada, Bristol, UK, and then we also have a small office and a small manufacturing facility in Pittsburgh. Okay, so financial summary. So for the last 12 months, you can see our revenue. Our Q3 2020 year-to-date revenue is up about $3.5 million, or 23%. And so that means the last 12 months is also up 3.5 or 17%. And the 24.6 million is the highest we'd ever recorded. The previous high was 21.1. So great results, and you can see that steady line upward where we've been growing. And of course, it always gets challenged more and more difficult. This is about a 30% compound annual growth rate. It's a lot harder to grow 30% compound annually off 25 million than it is off 7 million, but we're gonna do our best. Gross profit, you can see same sort of trajectory. You can see the gross profit percentage, the gross margin jumps around a little bit, but that's almost entirely due to product mix. So some of our products have higher margins. The gem trap, as an example, has a higher margin than the heat recovery. But on top of that, this lower margins in these 2 years, 2018 and 2019, was driven by one large project. It was an $11 million project. Obviously, if it's an $11 million project, the margin on that is going to be a little bit lower. So it had a lower than average margin, and it pushed our overall margin down a bit. In the LTM period, there's nothing in the LTM period from that large project, so margins are back in line, getting to be back in line with where they used to be. So you can see we have invested a lot. The increase in expenses is primarily people and other systems and technology that we've added. So we invested a lot in 2017, 2018, and up into the early part of 2019, and now that's starting to pay its dividends. And you can see, as a percent of revenue, our operating expenses continues to drop, which is great. EBITDA. So this is a huge turnaround. This is fantastic. We're thrilled with these sort of results. You look at our EBITDA in 2018 again. We sort of backed out some of these strategic growth-oriented investments, which were primarily people, but also extra marketing costs and things like that. If you backed it out, our EBITDA would have been in both years sort of around the $1 million mark. But now that these investments are starting to pay off, it's significantly more than that. Net income, basically the same story. So LTM net income, almost $2 million. And our cash position, we ended the quarter, February 29th, with $3.8 million, which is good. That's a great position to be going into the period that we entered in March with COVID-19. And the same with working capital. Working capital is an all-time high. It's never been higher. The last time it was this high was when we'd raised $13 million back in 2008. So $2.8 million in working capital. So a good solid position to enter the COVID-19 period of uncertainty for sure. So that's just a quick summary. 33% compound annual growth rate. We're at record results for on an LTM basis. We're growing well in new territories. So the people that we've hired recently have been in those strategic areas of Germany and Poland. And we're integrating the BEI products, which we acquired about 2 years ago. So to us, this last quarter of results especially it gives strong evidence that the strategy we started implementing about 2.5 years ago now, 3 years ago almost, is working. So this was nice because we had some record results, and then of course we all know what happened next. In March was not nearly what February was. So to give you a little bit of background, because we do customized turnkey best-in-class product, we pride ourselves in best-in-class product. Therefore, we always want to go out and do the site surveys ourselves and the facility visits. And to do some of the turnkey projects, you actually have to. So while most of our clients are essential businesses, they're food and beverage, they're pharmaceutical, they're not shutting down. But with travel restrictions, social distancing, and other, COVID-19 mitigation measures, that is definitely temporarily impacting our order backlog and revenue. We had a couple of projects underway. One in Scandinavia, for example. We were halfway through about a $2 million project, and when they shut their borders, they said, "Fine, you can keep coming to site, but anybody that enters the country has to do a 14-day isolation period." Well, that practically just eliminates the opportunity to do anything. So that project has been stalled, and we'll start back up as soon as those travel restrictions are lifted. And we had a number of cases like that. But what are we doing? Because business has slowed. There's no question. A lot of the projects sort of ground to a halt, so business has slowed. But we're taking advantage of the situation. That's really what we decided as a management team. We thought about what we could do, and we saw this as an opportunity because we know it's not going to be forever. We know it's not going to be that long. And after 3 years of business expansion and staff additions, we had a lot of catching up to do in terms of new systems, technology upgrades, training staff, because a lot of the staff are young. We hired a lot of keen engineers right out of school. And so we're using the current slowdown to improve and enhance our systems. We've got a whole schedule. Every day we've got new training going on. We've got technology upgrades. We're doing some R&D. And we've improved the connectivity and communication capabilities. So virtually everybody now, most of our staff are professionals anyways, but everybody now has, remote working capabilities. We use Microsoft Teams. Anybody can start a video call anytime they want. They've all got their own independent channel. So that has helped enormously. And so using the current slowdown to improve and enhance our systems and capabilities, it's not just that we're responding to the current circumstances. We believe we're also preparing for an altered state of business in the future. A small multinational company like us, the fact that we're doing business all over the world can be a bit of a challenge. If we can develop programs and opportunities and ways that we can do things remotely, that's going to help us in the future when business opens up. And what we've already seen, I'm sure you've all seen it, everybody is much more receptive now to video calls and doing things remotely. And I think to a certain extent, even when all these restrictions are lifted, that is not going to go away. People are going to be much more receptive to it. We've actually done a couple of virtual site visits where the customer wanted to, try and advance the projects. They're willing to go around with us with a sort of a phone, show us different things, and do the site visit together. And so all the things we're doing are designed to increase our longer term productivity and profitability. So we're really using the slowdown to our best advantage. And by doing this, we think we will emerge from this challenging period in as strong a position as possible. We entered this slow period in the strongest position we had ever been in our company, and we're doing everything we can to emerge from it in a strong position as well. And we want to be able to scale up so that we can meet any accumulated demand for increased energy efficiency. And I don't know whether that's going to happen or not, but it certainly seems likely when the things that we're hearing. But I'll believe it when I see it. And as I said, taking these initiatives now provides us with a clearer roadmap going forward and with improved productivity and profitability. There's the management team. One thing you'll notice, everybody other than myself and the CFO are engineers. And that's just a nature of our industry and our business, our professional engineers. The board, again, I think on the board, we've got 3 engineers out of the 6, and then a finance guy and an entrepreneur and myself. Last September, we were named one of Canada's top growing companies by the Globe and Mail in their inaugural ranking of Canadian companies. So that was, for what it's worth, it gets you a little bit of publicity, and it was nice to be acknowledged because we've had a great track record of growth over the last 3 to 5 years. And that's it. Enormous, fast-growing global market with strong market fundamentals, proprietary products sold to leading companies across sectors. And we think we're poised to continue our strong track record of growth once things start to open back up, and we're seeing those signs already. And so part of the strategy is to grow both organically as we have, as well as through creative acquisitions. We did do a search of the market before we bought BEI. A lot of the companies that have complementary technologies to us are quite are private, so we didn't know how big they are. And we were pleased to find just about everybody we talked to, A, was smaller than us, and B, didn't have their own sales force. So we have our own feet on the ground. There's a real advantage to that, not selling through agents and distributors, but having people in the markets that know the products and can sell. And so we see there's an opportunity to acquire additional technologies and push them out through our distribution channels. And that's it. Paul, if I can give it back to you.
It's fantastic. You probably took away 99% of all my questions.
Well, somebody just should have told me to shut up, but I'll just keep talking forever.
You're making my job real easy. I love it. Why don't we can jump right into some of the questions that some of the listeners have. I think we'll start with that. And if there's any that are sort of missed, I'll try to fire them away. But no, that was a great job. Okay, we'll start with this.
I'm trying to figure out how I stop sharing screen now.
We'll let Trevor figure that out while we're talking here.
Okay, go ahead.
Bill, the U.S./Trump is pulling out of the climate agreement. Do you see any impact because of that? How's that affecting your business?
Yeah, I hate to say no, but I'm going to say no because we haven't. Most of the things we do is driven most of the climate initiatives. And I heard a stat recently, and I can't remember the percentage, but it's only a very small proportion of climate change initiatives are sort of controlled by the federal government in the U.S. Most of it is done by the states. We haven't, certainly in terms of any incentive programs that exist or incentive programs that our customers have used, it's all been state driven. So we have not really seen any, the states that were keen on it before are still keen on it. And the ones that weren't haven't really changed, So you go to states like California and New York, they might have, a very aggressive targets. You go to, places like Texas and New Orleans, and they won't because, that's sort of the heart of the energy industry. So no, we haven't seen any. We haven't seen any impact at all yet. Okay,
good. Now, your product is really a one-off sale. Do you have any recurring revenue? And if in any of your future products, do you see any form of recurring revenue?
Yeah, I mean, no. Yes and no. I mean, in the products themselves, that's the challenge. It's a best-in-class product and a best-in-class service. And so, some people have said, well, maybe you should make it not quite so good, so it breaks down and that sort of thing. That's not what we do. So our products all our products will essentially almost last forever. And so in selling the product, we don't see recurring revenue. We do have a number of maintenance and contracts where customers will have us come and just check it once a year. But in terms of the relativity of that, if we had $1 million heat recovery project, the maintenance on the year might be a couple $1,000. So it's never going to amount to a huge amount. Obviously, what we would like to do, the one way to get recurring revenue is to finance these projects yourself and have the customer pay from the savings stream. That is difficult. Most of our customers don't want to do that. We're dealing with large multinational customers, and the only way to make that work is refuse to sell it to them on any other basis. And I don't think we're at that position. But we are always looking for opportunities like that. But really the way we affect and it's essentially a recurring revenue is developing strong corporate relationships. So I mentioned that food and beverage company. That's a huge multinational company with probably 5 or 6 major product lines and product brands. We've done $15 million in revenue with them probably over the last 5 to 6 years, 15 sites. That's only one division in North America. It's not the other 3 divisions, and it's not Europe at all. So there's huge opportunity that way. So that's how we generate sort of what is effectively a recurring revenue. Once you establish those relationships, in that case, you establish a good relationship with a VP sustainability or something like that at the corporate level. He's mandated to save energy across the portfolio. He will tell you which site to go to next. Often he has his own budget, so it's not down to the site. So that is how we sort of replicate recurring revenue.
I mean, that's one of the things I was so happy to hear, that you're really just sort of getting
just the tip of the iceberg in some of these opportunities with these major multinationals. Can you give a sense of what maybe your penetration rate is, sort of on an average basis for these, and what the upside still is?
Yeah, the penetration rate, as an example, the one that I told you about, that has where we have the highest penetration. We've probably done, say, approximately 15 sites, and that's 15 sites with heat recovery. We've done those same sites 50% gem. So there's still a gem opportunity. That's probably a few $1 million. That company, so that's $15 million in revenue. We're probably less than 10% penetrated on that company, as an example. Okay. And others would be the same, because other companies, most of our other corporate accounts, we've only been to, 1 or 2 sites at this point, and we're working on, the second, third, and fourth.
So, I mean, that's obviously the lowest hanging fruit. How much time do you spend going after, upselling your existing clients, and how much is trying to find new clients?
It's funny, because I've said to the sales team a number of times. I said, guys, we don't actually need new clients. You just need to sell more to the ones we're actually selling to. But I would say overall, if I had to guess now, we are probably spending 60% of our time with our existing clients, and 60 to 70, and 30 to 40% prospecting. But it really depends on the sales guy, right? We have, the 2 sales, each person sort of manages the sales in his area. And so it really depends on the person. Some people are very focused on a corporate type sale, and others less so. But overall, it's probably 60 to 70% of the time.
Gotcha. Okay, so we've got a COVID-related question here. Now, as of late, there's been some easing up of travel restrictions and sort of stay-at-home restrictions. Are you seeing any changes, within the recent past year that's making it a little easier for you guys?
In the recent, not yet. It's still, listen, we have a sales guy in Italy, and our Italian salesperson the week before last was out to 3 different customers after, being shut out of them for how many months? I don't know how many months. So we are seeing, the European economies are a little bit ahead of us in terms of COVID-19 than we are in North America. So we are seeing that those economies start to open up a little bit more, for sure. And, in some of the projects we've been developing, we haven't really seen too much of a slowdown. I mean, if we have to go to site, we have been barred from going to site. And that's mostly has to do with crossing the border, right? Even if companies that are allowing suppliers on site, the country isn't allowing anybody in. So that's been the roadblock. But we are, we do a sales call with the entire sales team every week, and we're starting to see those things start to open up now.
Gotcha. Okay, so you guys have a share buyback in place. Can you give us any details? How far you've gone? What are you looking for? Anything you can tell us around that?
Yeah, I'm not sure there's anything I can tell you. We bought it because when we're operating well, as you can see, we generate lots of cash because we have a low capital intensity business model. And so buying back shares has always been part of our strategy, and it has in the past, and then it will again. I can't tell you whether we're doing it now or plan to do it now, because it's every day is a little bit different. We have to see what happens. But it would be our intent that I believe in buying back shares on a reasonable basis. I think growing the business, generating lots of cash, there's always a balance. And I have that discussion with my board all the time. Should we be investing this in buying back shares, or should we be investing it in growing the business? And I always think it's a balance of the two. And that's really what we've done in the past. And that's what I want to continue to do. So where the opportunity presents itself and we think we have some extra cash to spare, we will continue to buy back shares.
Perfect. So here's a good question. Where do you guys do your outsourcing? Where's the manufacturing outsourced? Obviously, there's some areas that are a little bit more restricted than others. Where do you guys get your stuff?
Yeah, so it's still, the cost of the actual product that we manufacture, the cost of the product to us is usually pretty low. Most of it is in the technology and the service. So we still manufacture. The history of the heat recovery was North America. So we have 2 suppliers in North America that still make the majority of our heat recovery. And we have 2 suppliers in the UK that make the majority of our steam traps. And we're always, every year we're looking at, okay, we're at the point now where we should start stocking, supplying product in the 2 markets. We're probably at pretty close to that point right now. But there hasn't been any issues in terms of supply so far. So right now the steam traps are UK, heat recovery is North America.
Perfect. Okay, so question, what does the competitive landscape look like? What are your competitors?
Yeah, I mean, it's funny. I mean, there is other companies that have similar sort of products, but nobody's exactly the same. I would say, I can say pretty confidently that when it comes to both heat recovery and steam traps, we are best in class, which means we're also the most expensive, and many customers will pay for that. Where they won't, we will compete. We're happy to compete on price. Having said that, while there is other companies out there that are doing similar things, nobody competes directly with us. We don't know anybody else that combines the engineering and the turnkey solution with the equipment. So while some people might have a similar sort of piece of equipment, they're not installing it. They're just selling the piece of equipment. And so we see that as a real strategic advantage. Because when the customer, if they do a major energy efficiency project, they got to get a consultant to design it, engineering consultant to design it. Then they got to find an equipment supplier, and then they got to get a contractor to install it. We wrap all that up in one, and we say, look, by the time you do that, it's going to be a year, 2 years down the road. We could have it installed and already saving you money. And so all of which is to say, we generally don't compete. I mean, it's very rare. We don't compete on price. And we don't respond to, rarely are we ever responding to bid to spec. So when we go to a customer, they don't know they need us. We present the solution and they just go with us. On the odd occasion, they'll say, well, I better get an engineering consulting company to look at all this, but that happens very rarely. So most of the time, I'd say with 90% of our business, we're not competing against anybody. We're competing for the capital at the company. So they can spend their money with us, or they can spend it on something else. So we compete for capital, but we don't often compete directly with other companies providing something similar.
Right, gotcha. So are any of your products software-based, or I guess software as part of the solution?
Yeah, software's not part of the customer's solution. It's all the hardware. Well, there's a little bit of it. I mean, we are starting now to put in software where we can monitor. I told you we are starting to do a few maintenance contracts. So some of our customers have the equipment installed, so we can see exactly how much energy is being saved at any given time. But the sale really is the piece of equipment. The area where software is coming into play is in the design. So we've installed and manufactured 100,000 steam traps and probably 50 or 60 heat recovery units now. And so we are more and more getting that to be more automated in the design, where at least as an initial budgetary quote for the customer, rather than have to get an engineer to work it up, you can sort of put it into our proprietary database, and it can sort of spit out a price approximately for budgetary purposes. And then if they want to go any further, we can work it up. So that's some of the things that we're working on now during this slow time, an ability to more efficiently get projects out the door.
Cool. Okay, do you have any China exposure, either I guess as a geographic selling market or any product components or anything like that?
Zero. Yeah. So we had one person in China, and it's gradually, I inherited when I took over, the previous management was focused on China. They thought that was the next greatest market. And after a few years, I realized it's a really tough market. B, it's not a great market for best in class and best in service, because they want something cheap. That's basically all they want. So we tried selling gem traps there a couple of times. In both cases, our partner would come back and say, geez, I think we can sell a huge number of these traps if you can just cut our price by about 70%. And so literally just a few weeks ago, we cut ties. So we still have a company there, but it's basically a shell. So we have no operations whatsoever in China anymore.
Gotcha. And another question, geographically, Japan, do you sell anything to Japan?
We don't yet, but we think Japan would be a great market for us. If we thought, we haven't yet because we have such huge opportunity in Europe. So in Europe, we just got into Germany a couple of years ago. We just got into Poland about 2 years ago. We're not in France yet. We see lots of opportunity in Europe. When we look beyond Europe, where would the next good markets for us would be Japan and South Korea, because in both cases they're sort of excellence. Their industries, a lot of their industries are built around excellence, and they will pay for quality, and their energy costs are very high. So those are two markets that we are always keeping our eye on, but so far we haven't done anything because we've been busy enough in Europe and North America.
Okay, perfect. Okay, maybe a couple questions around the stock in the capital markets. You've got 160 million shares outstanding. Have you ever talked about a rollback to?
We've talked about it many, many times. I still haven't decided to do it. And, maybe we're getting close. I'm a little bit sensitive to it because a lot of times I've seen data and studies done to indicate that, on average, they're value destroying, not value creating. But I think every case is a little bit different. If we get to the point where I think the company is being valued appropriately, I think we would consider it, and we'd probably wrap it up with some other news, whether we did another acquisition or we were doing a capital raise or something, and do it all at once. So it's something that's always on our mind. We know 160 million shares outstanding, trading at cents is not, a good way to be, but we haven't seen yet the right time to do it. But we do talk about it probably several times a year at the board level.
Gotcha. And what's the insider position look like, and maybe other sort of share structure?
Yeah, components? so it's I can't remember the exact percentage, but I think the insiders are just under 10% or around 10%. But something, I am the largest. I've got about 6 million shares. What's that add up to? 3 or 4%. But you have to realize that all those shares that are owned by insiders, whether they're owned by the board or they're owned by management, were all bought on the open market. None of those shares that we own were given to us. The founders of the company are long gone. So those are all shares that were bought on the open market with their own money. And beyond the insiders, there is no large shareholder that owns more than 10%. So it's overwhelmingly retail at this point. There's a couple of shareholders that own more shares than I do, but I'm probably the second one down, second level. There's 1 or 2 shareholders that might have a little bit more than me. There's one shareholder that has more than me. There's a couple of more that are around me, and everybody else is below me. So it's a diversified shareholder base.
Right. And are you aware of any institutional ownership or sort of anybody sniffing around, I guess, as well?
Not significant. Yeah, well, there's always people sniffing around, but nothing significant. I'm not aware of any significant ownership at this time. And I think it's still a little bit small for a lot of institutions, but we're getting, it's another unfortunate fact that we started to get a lot of attention thanks to, Paul and Trevor's good work, just before the pandemic. So we started getting all kinds of phone calls, and then the pandemic hit. So it's, it's unfortunate, but it'll come back. I do think things are going to be positive after this. I'm hearing a lot of news about governments, the European government, the German government, talking about tying not incentive programs, but stimulus packages into green jobs and carbon emission reductions and things like that. And people are talking about that this was, the pandemic was terrible, but the next one could be a lot worse. Let's make sure we get it right. And I think everybody's enjoying the cleaner air that we have these days. So I'm positive about the future for sure. But I know that wasn't your question. I just went off on a tangent there, Paul.
That's perfect. It sort of ties in a little bit to the next question that I was going to give you. The price of oil is sort of crashed. Some places natural gas is still cheap. Are you seeing any trends, or do you think the future of ESG is altered because of that?
Yeah, I think. I mean, I opened the conversation that our product is purchased. Our customers purchase our product because it provides them a good return on investment, and the return on investment is driven by the price of their energy. Having said that, what we have seen over the years is people's interest, and it really depends on the company, but people's interest, the paybacks have been going up. Like what they will accept as an acceptable payback in the ESG side has been going up. Natural gas was, a quarter in North America was a quarter the price it was in Europe, and we still did projects in North America. And we are still looking at projects in North America. Most companies don't, if these are large multinationals and they're making an investment that's supposed to last 20 or 30 years, they certainly don't make those decisions based on the spot price, right? They look at what the average price is, what they think the expected price will be. I know there's a lot of forecasts out there that, that people think that maybe it'll go down permanently. I'll believe it when I see it. I think it's long term, you are going to see gradual decreases because we are sort of decarbonizing, but we've got a long way to go. And, you can look at the chart that Lawrence Livermore Laboratory, you can see the majority of our energy still comes from fossil fuels. I don't think that's going to end anytime soon. And most of the climate change initiatives involve around just using less through energy efficiency, not totally converting to a sort of a renewable source. So it will have an impact for sure. But at the same time, I think there's going to be greater demand from governments and companies to reduce their carbon emission that will offset that. So overall, it's probably net neutral.
Mm-hmm. And I know you mentioned it in the presentation, but I want to sort of re-ask the question. What's a typical payback? I mean, these are saving a fair number of dollars in energy costs and maintenance.
It depends. It's so I'll tell you a little bit about the sales cycle and the sales process. So because everything's turnkey. And you can imagine that there's, diminishing returns of every dollar of energy you save. So when we go to a customer, they'll say, well, how much can you save us? And we'll say, well, what are your return requirements? Because, we could save you $1 million with a 2-year payback, or we could save you $2 million with a 3-year payback, or $4 million with what do you want? A 5-year payback. But, and so what we are seeing is historically, if it was pulp and paper, they weren't interested unless it was a 1-year payback or less. And that would gradually go up. The chemical might be 2 or 3, food and beverage might be 4 or 5, hospitals could be 5 or 6, but we're seeing all those thresholds increase. So our paybacks still to this day in North America are probably around 5 times on average. And that's just because once it gets above 5 times, there's less interest. And the paybacks in Europe can be sort of 2 times. So it still ranges sort of from the 2 to 5 times, and it depends on the product too as well. But with energy prices where they were last year, those are the sort of paybacks that we were getting.
Yeah, timing is absolutely perfect. I've got a window washer right behind me, right in the window. So if you hear some stuff in the background, I apologize. Okay, here's one. How important is the carbon dioxide thesis to the company?
Sorry, say that again, Paul, the carbon tax?
Okay, so how important is the carbon dioxide thesis to the company? Is carbon dioxide reduction incidental to improved energy efficiency? Is this marketing or actual focus of the company? So
yeah, we do. I mean, it's a direct correlation. The amount of energy you save, there's a direct correlation between the amount of energy you save and the carbon you're reducing, right? So it's you reduce a carbon, you reduce an atom of natural gas, and you're reducing an atom of carbon dioxide. But so far, we've seen, the customers are still focused on. They like to advertise the carbon emission reductions, but they're still focused primarily what drives the buying decision is the return, the financial return.
Yeah, fair enough. Right, so we're sort of near the end of the questions here. I want to always give you guys an opportunity to sort of give us a sense over the next 6 months what an investor should sort of look forward to. I know it's going to be a challenging couple quarters until stay-at-home orders are lifted. But what do we look for in the next 6 months that you can sort of highlight?
Yeah, well, a pickup in orders, I think that will be the key. And we don't announce everything, but we'll try and give people sort of updates. We did see, our order backlog is low right now, and it was interesting. We saw across the industry whether it was the US or the UK, and across all products, both the heat sponge and the gem and the Fluace. For whatever reason, we couldn't explain it, but everybody was saying that in January and February, there was a slowdown. Customers just seemed to be putting the brakes. They seemed to be thinking a little bit more about it. So whether customers were already expecting a bit of a slowdown before the pandemic hit. So as a result, we haven't had a lot in the way of orders, this year. Large orders. We're still getting in the regular orders, but in terms of large announceable orders, there hasn't been a lot. But the projects that we're working on are still percolating along. Our customers still say they want to do them. So it's interesting. One of the things we're doing now is normally we're very reluctant to do any free engineering unless the customer commits to a project. Right now, our engineers aren't busy. We strategically decided to keep all our staff and try and keep them as busy as we can. So right now the engineering is free. So we've sort of looked at on a case by case, where does it make sense for us to go out on spec a little bit and continue working on this project, because the guys don't have much else to do anyway, so that when the time comes and the customer is ready to write the check, we are ready to go. So, I mean, it will really be over the next 6 months. It's anybody's guess. But to me, I'm looking for the orders to come in. Like I said, our sales team, in the sales calls we have every week, it looks pretty positive. But, as my CFO likes to say, in my hand, she hears the sales guys always talking about this orders coming in. And she goes, in my hand. Once it's in my hand, I'll listen to you. So it looks positive, but that's what I will be looking for. We've got a plan in place right now to manage the company, keep everybody employed, keep everybody busy, for 3 months. That takes us to sort of mid-July. And, starting sort of mid-June, we'll start thinking about the next 3 months. But we weren't really expecting much of the way of business, until sometime after mid-July.
Mm-hmm. And what keeps you up at night?
I don't know if anything keeps me up at night, but, it is a non-recurring revenue model. I'm not worried about the business. We got in as strong a position as possible, as we possibly could. I think we're in a very strong position. I think I won't say what keeps me up at night, but what is the challenge in the business, and that's scaling the business and managing the projects. It's easy to do 1 or 2. We're now doing 10 or 12 projects. And you really just have to be, how do you manage that? How do you scale that business? How do we improve the efficiency? And so that's what we're always working on. How do we, our sale is based on expertise. How do we get the expertise all over in our different markets with a young sales team? And so that's the challenge that we're working on right now, to try and scale the business better. I mean, we've done a good job. We've gone from $7 million to $24 million, but 30 people to 60 people. But that's going to be the challenge for us going forward, is continuing that growth and effectively and productively scaling the business.
Mm-hmm. Fantastic. Okay, we're near at the end of our time. What we usually like to do here is just have you sort of wrap it up by giving a message or whatever point you want to make sure the investors are leaving this presentation with. So feel free to just give us whatever you think is something we walk away with.
Yeah, I think if you just look at our track record, right? You go back, 5 years. We've had a consistent record of growth. We ended the 12 months ending February 29th in the strongest position we've ever been in. Then COVID-19 pandemic hit and things slowed down. But we think the strategy worked and the strategy is right. We entered that period in the strongest position ever, with almost $4 million cash on the balance sheet, strong working capital position. We've got a plan in place now to keep everybody employed. We haven't let anybody go. We don't intend to. We've got an incredible workforce, talented workforce. We want to keep them engaged, and we're spending the time right now, these next 3 months, to make sure we're ready to hit the ground running when our customers want us to move again, and they will want us to move again. So, it's almost it's not a blessing, but, we're making the best of a bad situation, and we will be a stronger company coming out of this.
Fantastic. If people want to find out more about the company, what's your website address?
www.thermalenergy.com.
Perfect. Bill, I want to thank you. This has been great. I want to thank everyone for listening. I'm going to turn it over to Trevor, and I'll let Trevor wrap it up.
Thanks, Paul. And yeah, also thanks again, Bill, for spending time with us, giving us a brief update on the company and where things are headed. And, we look forward to following, future disclosure and upcoming financials.
Okay, well, listen, Paul and Trevor, thank you. And I've said it before, and I don't mind saying it again. The report that you guys wrote nailed it. It probably nailed it better. You had better insight into our business, I think, than any report I had ever seen, because you understood how the business worked, and that there is going to be, quarter over quarter, some variability to it. And that's why I always like to focus on the LTM, because it smooths out that quarter over quarter variability. So you guys did a great job, and I appreciate the opportunity.
Hey, thanks so much.
Awesome.
Okay.
Awesome. Thanks, guys.
Thank you very much. Take care.
Okay, Bill, we're gonna wrap up with you. What we like to do is we have about 5-minute chat.